So I'll keep it going and short. So another 45 minutes it takes to take you through what are the steps of financial planning in a changed environment like what we are living in today, and how it will benefit you. So some of the issues will like Soumya said, we do come across many doctors and at different hospitals where we having a tie-up with, and individually with some of you, and we often listen to some of the good things as well as some of the areas of improvement which doctors need to do in terms of their financial planning. We keep listening to India growth story, so we are going to evaluate how it is going to benefit each of us and how true is this India growth story is about. And today, as we progress, we will get to see what was the investment strategies we as a community Indians have followed in the past, and how is it changing with time. So we're going to see that today. And we are also going to see a brief touch on how to stay away from frauds and the short-term money-making objectives, etc. And we are also going to see how tax efficient should be our financial plans are. So, like she said, you may want to ask a couple of questions wherever you think you need further explanation, etc. Please note it down. End of the session, we will have a Q&A where I'll try to address, and my team is also here today. They'll try to address some of the areas where you need more clarity, better clarity, etc. So, just to start with, where do we see a gap in financial planning by doctors in some of them? So, one, of course, we can say lack of diversification. And whenever we talk about doctor, one thing comes in our mind is the professional expertise, what they carry in terms of their medical profession, and the kind of dedication what they have for medical profession. So, thereby, for their personal things, like financial management, like many other things, you find less amount of time. So getting a doctor is like almost next to impossible. So one, when it comes to personal finance, there's a lack of diversification we feel, where either doctors are generally loaded up with fixed deposits or real estate or with chit funds, etc. We have also observed people chasing hot returns like crypto, algo trading, etc., and then easy way of making money, or believing in promises through people which come across to us, like multi-state cooperative, which is an MLM companies. We see a lack of protection, inadequate protection in your personal financial management. We do sometimes see tax, and this is probably doctors could be the community which pays highest amount of tax in the country. Maybe a little bit of efficient planning can reduce the tax liability by each of you. And like whenever we are ill, wherever we are having an issue with health, we always reach out to the best doctor or the non-doctor in our community. So when it comes to personal financial management, maybe we don't see that much of a time allocated to discuss that with a professional expert in banking or finance, etc. And thereby, uh, some of the doctor community may get into some scams and frauds, and some of them will get into rebalancing issues where we understand people been holding 7% rate of return for years together, 6%, 7%, 8% rate of return for years together. So some of these are the observations commonly we have seen with our interactions with some of the professional doctors. I don't attribute all this to you because we haven't hardly experienced or discussed. So this is a general observation. Now, how is the world is changing in terms of its financial management strategies? So traditionally, if you look at it, Indians have been investing in gold as a popular, and this is the most popular asset class. And chit funds are the next best, or chit funds are equally very prominent just because of the ease of doing. And like all of us know, it is a mutual benefit scheme. So mainly it works as a loan, but we generally believed that it is a great investment tool. Fixed deposit, which is the easiest and safest, where we get a assured guaranteed return and easy to operate. So this would be most common thing among all of us. Real estate, by nature of the good time which real estate had from 2008 to 2014 15 kind of a scenarios, cities like Bangalore, Hyderabad, due to the industrial exponential growth, what the kind of real estate return it created. So these were the traditional way of investing for our parents and the earlier generation, and some of it were right also. So we can't say all those investment methods were wrong, because some of them, I don't know how many of you remember, there was a time when I joined the banking industry way back in 2002. Rate of interest, and I used to see fixed deposit receipts where people used to have 18% return, 22% return, and all. So yes, you heard it right. What the today mutual fund is giving used to be given as a fixed deposit interest rate 20, 30, 25, 30 years back. So at times these were also good investment, but not need not be uh, in this current scenario. So we're going to cover some of it. Now, the biggest challenge what we face today is inflation, and inflation has been there. So, if you look at it, India's inflation for the last 10 years has been around 6% plus. Last 5 year could have been around 7%. So, cost of goods are increasing year on year at a 6 to 7% range. So, if you don't have a real income, which is inflation adjusted income, grows better than this or above than this, above than the previous year, it is not going to help you to buy the same amount of goods and services in the current year with the earlier year's money, which means last year's 500 rupees, you're not able to buy same goods and services. You may have to shell out 106 or 107, and the next year is going to be another 6 or 7 percentage more than this 106. So every year it keeps increasing. I would just leave a thought to you: when you go to fill the petrol and any of the fuel, you understand that the heat of inflation. And some of you definitely goes to buy jewelries. You can see the gold prices, it is going up year on year. It is far higher than the 7%. 7% is probably weighted average cost increase of all the goods and services put together. But some specific item, when you look at it, it is far more higher. Because of this, because of inflation as a factor, we need to probably need to look at it professional wealth management with diversification, where we may need to put our money into different asset classes. We may need to look at it taking informed decision. So in financial industry, even if it is GB George or Trinity or anybody for that matter, ask questions, so that whatever decisions you take about your personal finance, about your money, is in an informed state. And believe the professionals in this. Trust the professional. So don't try to listen to all the information. Today we are in a stage where information overflow is happening. Social media is one good reason for that. But don't trust everything which comes in social media. When somebody says buy this share, it is bound to go up, remember that there could be a vested interest in that. So depend on a couple of professional managers where you can have the right set of advice for your personal finance. Timely review. Where your money is, your mind should be, or your heart should be. So wherever you have invested, you need to ensure you're taking adequate time once in a quarter or so to review and to get satisfied that your investments are in the right place and right growth. Moving on. So we've heard about India growth story all the time. So what is India growth story? We are going to examine, is it the story is right, and am I getting benefited out of this growth story? So we all heard our Prime Minister talking about Vikasit Bharat agenda by 2047, another 25 years down from now. As India celebrates its 100th Independence Day, possibly India is set to become a developed nation status. And we are now growing at a much faster pace. So, what will that reflect to 25 years down the line? Have you ever thought of? So, probably our population from 140 crore will increase to 165 crore. So, this data source is from Niti Aayog. So, you can reasonably depend on that. It is not somebody who created for a purpose. Median age of the population is going to increase from 29, which is currently the lowest one among the large populated country, to 37. Life expectancy, where each of you would be taking part of in improving it, will improve from 71 to 84, thanks to advanced medical sciences and professionals like you. Working age group will expand from 96 crore to 112 crore. Literacy rate thereby will improve. Skilled labor will improve. Female participation, labor participation, women participation is expected to go up to 70%. Right? And the last few things are pure economics, where GDP, India's GDP, which is currently at 3.6, $3.7 trillion, is expected to be 30 trillion by 2047, another 25 years down the line. Per capita income is expected to go up by 8 or 9 times from now. So there will be an exponential growth in per capita income earned by you and me and all of our fellow citizens. Industry contribution is expected to go up. So India is set to definitely go up as a developed nation. And in this journey, which is not started today, which is started, let's go back and see this slide straight away, where India is almost, this is the world economic order of top 10 economies from 1980 to 2030. 50 years, what has been, the next 30 is projected, rest everything is in actual. So if you look at it, China, you can see it in the left side. China has become the top 10 global economy only by 1980, where India was not even part of that. So India slowly, and China continued there in the next decade. And in 2000, year 2000 or the decade 2000, China has climbed up 4 positions and become 6th largest economy in the world. And mind you, India is still not there in that picture. You cannot see India in the first 3 columns. India has become part of the top 10 club only by 2010, thanks to the economic liberalization policies which we followed maybe from 1995 onwards. And China by then had become top 2 in the world economic order. China continued to be in top 2 and India climbed up to top 6, and currently India is in top 5 position, overtaking United Kingdom. And it is set to become the 3rd largest economy in the world by 2027-28. Before we touch 2030, India is expected to be 3rd largest economy in the world, and whereby possibly China will overtake and become largest economy in the world. Between US and China, it's always can be a debate, but India definitely is going to be the 3rd largest economy by 2030. So how am I going to benefit out of it, or how am I going to feel it? So possibly you can feel it when you see some of these real numbers. So now you can start with the mutual fund part. The first part you leave it. You can see the digital transaction. Digital transaction in the country is 76% of our GDP, which means most of the transactions happening in the country is by digital way. Your Google Pays, IMPS, your NEFT, RTGS, and whatnot. I remember. I mean, I'm sure you wouldn't remember where your checkbook is. You would have hardly used a checkbook in the last couple of years or so. It's all digital now. Foreign direct investment in India is going up significantly. You can see it here. Highway network, it is foreign direct investment is more than doubled. Highway network more than doubled in the last 10 years. All of us could be the beneficiary of that when you travel for long distance on road. Electrification has gone up substantially. GST collection is 3 times higher than what it was, say, 5 years back. And mutual fund investment, which is capital market investments, is now 60 to 63 lakh crore, which used to be 8 lakh crore in 2013. So how much capital formation is happening through secondary market? How much national highway network is happening? How much foreign investment is coming to India? How much GST collection is going up? How much electrification of railways happening? So you are also able to see the kind of rapid growth happening in the country. Thereby, India is one of the fastest growing economy in the world. So this is the GDP growth projection of International Monetary Fund for the world. And you can see India, right, building on the top, towering on the top at around 7% annualized growth rate. And China is next to us, probably expected to grow around 5.5%. You can see Western world, which is UK, Europe, is expected to go 0.5, 0.6% from the current level. The world at large will grow around 3.2%. You can see it here. You can see it here. So India is expected to maintain double the growth rate of average what the world is expected to grow. It is expected to grow 2% more than the China, which is our nearest large economic competitor. Expected to grow 10 times higher than or 12 times higher than what UK is expected to grow or Euro nations are expected to grow. So India will maintain the fastest growing economic tag for the years to come. So what will that reflect into? Like we have seen already, the average age of Indian population is 28, much younger than compared to many other countries. So which gives us a better workforce, which gives us a better GDP acceleration over the years. And India is upper middle class and high net worth group. This is a good news for all of us, huh? Because we expected to. So India's upper middle class and high net worth group is expected to be currently at 8%, is at 8% 10-year back, which is currently at 24%, expected to be 51% by 2030. So what does it show? That lot of millionaires and billionaires India will produce in the coming decade. So the question which we need to ask is, are we one among them? Are we going to be one among them? So now if we have to increase our income, if we have to become the top layer of economy, then we need to take certain right steps in our financial planning. What are those steps which can help us to accelerate our income? One is surely investment. Second is loans, structuring of loans, or how loans can leverage us. How de-risking help us to maintain financial prudence, and how retirement planning, etc., can help. So let's look at it, some of it in detail. So today, in Indian equity market, from what it was earlier, it used to get loaded with real estate assets, gold asset, and fixed deposit used to be the traditional way of investment style, are moving into this five different type of equity investment structure. So one is, like it is stocks, direct stocks, picking up Infosys, picking up Apollo Hospital, picking up Aster Medicity, and so on and so forth. So it require on time and expertise. For people who are busy but don't have this expertise of picking stocks, mutual fund will be the better second best option, where in which people give the money to a mutual fund company or an asset management company, right? Like ICICI Prudential, HDFC Mutual Fund, Franklin Templeton, etc., where they will appoint investment managers who will manage mutual funds most reliable way, and they'll give you the same stock return by taking a small service charge at their end. The third option for people like me and you to look at it from stock market to make gain is advised portfolio, which is called intelligent advised portfolio or investment advisory portfolio, where there will be automated strategies which will pick up 20, 30 stocks, make it grow, and you can see it in your demat account, which is growing, and then you can exit, book the profit at the time where you wish to. Fourth one is portfolio management. This is for high net worth doctors like you, where people can invest into stocks and gain out of it by giving that advisory, giving that management to professional portfolio managers. And the last one possibly is what is available today is alternative investment, which is the highest in class, where minimum ticket size is 1 crore. And again, the fund will be able to invest in listed and unlisted stocks, debt, real estate funds, etc. So we're going to see some of it in detail. So what is the tradition? What is the change happening in the country is people are moving slowly and steadily, diversifying their investment from fixed deposit and real estate and gold to things like portfolio management, mutual funds, and alternative investments. So everybody knows this Infosys story where someone would have invested 30 years back at 10,000 rupees would have probably become 11 crore 32 lakh today. Yeah, it is very interesting to see that 10,000 is becoming 11.5 crore. But how many of us, had we had the sufficient funds in 30 years back, still would have invested into Infosys and maintained Infosys stock for 30 years? So that requires long-term strategic vision. It requires stock picking skill. It requires you to review and keep maintaining perseverance, and also need you to book profit as and when you think that the right time has come. Imagine that had you picked up Kingfisher Airlines instead of Infosys, possibly that would have become completely wipe off your investment. So this require an art and skill like a medical profession to pick up the right stocks, nurture it, maintain it, and book profit. If we don't have time and expertise for that, then comes this kind of a managed portfolio, which is advised portfolio. It is this advised portfolio can just manage from anywhere between 5 lakh onwards, and it requires you to open a demat account and give a power of attorney for the funds to manage funds in your account. They will buy shares, sell shares, and create a wealth over a period of time for you. So remember, every investment has its own risk. I'm not coming to the risk now. I will cover the risk as we come to the towards the end of the session. Third way of making money strategy is mutual fund. While I would request all of you that this session's importance is that to give you an overview of different investment strategy. This session is not intended to give you specific investment advisory or guideline, which for that we may need to do a separate session individually with each one of you. So this is to give you different ideas and strategies. So now coming to mutual fund. Mutual fund is the easiest and most popular way of investing into the equity market, where any time the investment can be as low as 500 rupees, as high as 500 crore also. It can be invested through monthly and lump sum mode as well. It can be invested for short term as well as long term. Redeem any point in time based on your requirement. It has a combination of stocks, bonds, and NCDs on government securities, and gold. All combinations you can work out in mutual fund. So India has around 40, 42 mutual fund companies. Like some of it, you would have been experienced it already. So it is available. Now, how the mutual fund typically works? It gives you, it will invest in stocks, bonds, cash, gold, etc., depending upon which fund are we taking. So I'm not spending time on this because this is just as an example. But this slide is important to you. Last 20 years, if you look at it, 3-4 asset classes, 3-4 investment strategies. One among them is mutual fund. Second is a stock. Third is a fixed deposit. Fourth is gold. Just see how each of the investment class performed in the last 20 years. And these are all actual rate of return. An HDFC top 100 mutual fund would have given you 21% annualized return, where your 5 lakh investment 20 years back could have become 3 crore 63 lakh. A 5 lakh investment 20 years back would have been equal to 3.5 crore. Since the fund has delivered a 22% return year on year. Meanwhile, you would have picked up large cap stocks, 100 stocks of Nifty or Sensex. That would have given you 17% annualized return, giving you a return of 1.65 crore. But had you invested that same money into a bank FD during this time, possibly it would have given an average return of 7%. 22 lakh would have been your maturity value. And gold would have given you 9.3%, which is gold has outperformed the fixed deposit and would have made that money, 5 lakh investment, to 35 lakh in 20 years' time. So what does it say? That different asset classes can definitely give you different return. Of course, risk is different for it, but then mutual fund at large, stocks, right picking of stocks can give you better return. So people can invest into mutual fund lump sum or in a systematic investment plan. So in this limitation of our webinars are that I can't ask you a question and you can't answer. So I'm assuming that most of you would have invested into mutual fund SIPs at least. So people can make money through a monthly deduction, monthly SIPs over a period of time like this. A 5,000 rupee SIP carried for 10 years possibly can work out to a 14 lakh kind of a number. 20 years, the same 5,000 rupee investment for 20 years could get you a 75, 80 lakh. And 30 year, it can make you a crorepati at a 3.5 crore. So these are all assumed returns at we would have possibly taken a average return of last 20 years and would have given you. So there are different mutual fund from low risk to high risk can give you different return for 10 years, 5 year, 20 year, etc. I'm moving into the fourth strategy on wealth creation. So we've seen first one was in direct stock picking. Second one, we discussed about advised portfolio. Third one, we discussed about mutual fund and SIP. Fourth one, we are discussing portfolio management service, PMS. You would have heard it or yourself or you would have heard your colleagues talking about it. So these are all investment for 50 lakh and above minimum ticket sizes, minimum investments. And this is given to SEBI approved portfolio managers who manages the fund based on the strategy and give you higher return because it is very concentrated personal strategies working out for high net worth clients who is willing to put 50 lakh kind of a capital investment, right? So those people can subscribe to portfolio management. So you can see the return over here last few years. It has given an average return of anywhere between 18-20%, 20-25%. So based on the risk of each of the portfolio, for which you need an advisor to advise you, and based on that, the return can be different. Here also you can see somebody is given you 22% average annualized return, somebody 31%, somebody 16%, somebody 22% based on the risk of different fund strategies. The return also varies. So somebody will say, I don't want any risk. I want very safe investment tool. Then probably this PMSA strategy, has delivered a 15%. So depending upon each of our personal choices and risk appetite, we can definitely invest into PMS as a good wealth creation strategy. I'm moving on to the next one because we also need to ensure the time is maintained. So the fifth strategy we are going to discuss is Alternative Investment Fund, popularly known as AIF. AIF. And AIF is comparatively a new investment vehicle which has come up in 2016 with SEBI's, SEBI is low on AIF. So investment has to be minimum of 1 crore and above. And it can create better return. How the better return? Because it can invest into unlisted stocks also. It can create a real estate fund from through AIF. It can create global funds through AIF. So AIF possibilities are much more than what we think, and there are a lot of fund houses like Motilal, Prudential, Nippon, ASK, Aditya Birla. Right, some of it are delivered superior return because of their pre-IPO investment stage in like Zomato's and Swiggy's, etc. Another benefit of AIF is taxation is at especially category 3 taxation is by the fund. The fund will pay all applicable taxes and give it to you as tax paid. I wouldn't call it as tax free. It is not tax free. It is tax paid by the fund. So there is no liability for the investor to pay separately. So AIFs can be classified under these 5 different categories, which invest into one category can be the Indian equity. Second, invest into performing credits. There are funds which invest into real estate co-development funds. There are AIFs which invest into global equities, and there are global others, non-equity. So possibly the return also differs. This is a past returns anywhere between 22, 27 to 15, 18, depending upon what kind of a risk we are willing to take it up. Depending upon the risk taking ability, we will be able to invest into different AIFs which can give a better differential return over a period of time. So I'm skipping this. These are all different type of AIF strategies. In that also you require an advisor to go for. The sixth strategy this evening we are going to discuss is corporate FDs and NCDs. So FDs are not a bad asset class, but putting all the money into FD possibly is one need to relook into. So compared to FDs, there are corporate FDs like Bajaj Finance, Mahindra, Sriram, which can give a better than bank FD rate. And they're all much stable, much safe when it comes to rating also. And there are NCDs, which can also give 8 to 9% or 10.5% return on a fixed term basis. So if you look at it, FDs and corporate FDs and NCDs give a fixed return, where mutual fund, stock related instruments give you not a fixed return, market related return, depending upon the company's performance. Gold is also traditionally, we have seen gold has been a great investment. This is given 9.5% annualized return over the last 30 years. So gold is definitely not a bad idea. You remember some time back, Government of India came out with sovereign gold bond as a big opportunity. It was a borrowing scheme of the government, where government was giving 2.5% rate of interest plus gold appreciation. I think government ended up paying somewhere around 13.5, 14% for the first tranche of investment by the time it matured. I'm talking about annualized return. Annualized cost government had to pay somewhere around 13 to 14%. That is why this year you haven't seen any sovereign gold bond scheme announced by the government. And the government is not going to take gold as an investment because the price of gold has gone up so significantly. So the government had to pay a higher amount of cost at maturity to the investor. So gold is definitely worth trying as an investment strategy. So we have seen, this is just to consolidate, we have seen from corporate FD to gold, to bonds and debentures, to mutual fund, PMS and AIF. There are different investment strategies in New India where one can expect to get a 7 to 8% return to 20 to approximately 15 to 20% return on a conservative basis from the equity investment. You can see it on the next column. The risk, which I promised you that I will share, is going up from almost nil risk to very high risk. So as the risk increases, risk level increases, your ability to get a better return also increases. All these investment which we discussed today are governed by either RBI or SEBI as a regulator. And the tax system also, this is another best advantage which one has to take attention to. Your fixed deposit or fixed income securities are taxed at 30%, or your slab rate. I wouldn't say 30%. Whichever is the income slab you are in, your incomes are taxed at that level. But when it comes to higher here, higher the return, which is high risk investment, market linked investment, where your taxation comes down to 12.5%. It was 10% till the budget is increased to 12.5% for long term capital gain, which is 1 year plus. So the tax rate is favorable, return is favorable. Only thing what you need to take is higher amount of, slightly moderate and high amount of risk associated with those investments. And this is what diversification, which talked about, one need to have different asset classes, investment classes in your kitty. So I think we have to line up conclude our our session in the next 10 minutes. So I will go slightly on a faster track by taking this, that whenever somebody talks to you about investments or financial planning, ask this 5 R's. First, don't ask them what is the return that investment can give it to you. Instead, you should ask what is the risk associated with this. This 5 you should not forget. What is the risk associated with it? What is the return one can expect? And who is the regulator? Remember, cryptocurrency having a wonderful idea, but there is no regulator. Hence, the risk what you carry is humongous. And the fourth one is redemption, because when you need to take your money, take the fruit of that investment, whether that system allows you to take that redemption and review. Like I mentioned, wherever your money is, spend 30 minutes in a quarter in 3 months' time to review your financial investment. So that these 5 R things is a typically we would call it as important steps one need to take it for a successful financial planning. Traditional opportunities, you all know real estate, people have been investing heavily, but it has its own advantage and disadvantage. Disadvantage, if you look at it, it is high volatile, there is no regulator, it is broker driven market, and high stamp duty, high illiquid asset. It is not a liquid asset. Whenever you want to redeem it, you want to make profit out of it, it is very difficult to realize unless you are lucky and you are in some cities like growing cities, fast growing cities like Hyderabad or Mumbai, etc. But still, there are a lot of implications on stamp duties and taxation, etc., which you need to go through. Chit fund is a very popular way of investment, but we do analyze chits and have found that chit funds are a good saving instrument. You must note here, it is a good saving instrument, not a investment vehicle. Because if you look at it, some of the chits which we have analyzed, like 25 months chit, first 20 months when you take back the money, it gives you negative return, except when you wait for maturity, it gives probably a 7.5% annualized return. And there is no regulator for chit funds. So chit funds are largely operated by informal sectors and money lenders, etc. So to conclude on the investment, see this slide where we have analyzed a fixed deposit, a average return mutual fund, and an equity mutual fund to see what changes it can bring in the end result. If you keep a fixed deposit for 5 years at 7%, you are paying, after paying the 30% taxation slab, you will net gain 2.8 lakh. Wherein which if you are intelligent enough, smart enough to put that into a average return mutual fund. Remember that in discussion we have taken HDFC top 100 mutual fund, which has given 21% return. Here, if you're taking a very conservative estimate of 11% return, since the tax rate is very low, you would earn 6 lakh rupees net revenue as compared to fixed deposit net return of 2.8 lakh, which is double. Hence, we called it a 2x. An equity mutual fund, assuming that that is giving you 15% annualized return, that'll give you post-tax 8 lakh, close to 9 lakh return, which is 3x. So a FD can, if it can give you 1x return post-tax, a conservative mutual fund can give you 2x return, and a PMS equivalent can give you 3x return post-tax. Of course, please understand the other things are guaranteed. The fixed deposit is a guaranteed income scheme, where in which mutual fund or equity has its own risk associated with it. So, having seen how better investment, smarter investment can accelerate your wealth from a traditional style of investing, which is real estate and gold, there are other tools also to support you in financial planning. One is, of course, loans. There are multiple loans available, but I wouldn't want to take loans in this session, which because the nuances will take more time and de-risking. So whatever wealth we have created, if you don't plan it and take it in appropriately, life risk, health risk, etc., you end up losing the money what you create on emergencies, on exigencies. So this is also another big topic which I would cover it separately. I don't want to take your weekend for too much of information. Those who are interested in can always refer to our YouTube channel, where we have covered this too in a different webinars altogether. The recording is available. Now, I would want to definitely, so like I mentioned, life has got many risks and uncertainties like life risk, property risk, health risk, liability, cyber security, etc., which we will cover it separately with you. And the third most important, fourth more important thing which we need to cover this today is retirement planning. So while we all think that, what do I do with the retirement? And this will tell you that cost of living we've seen increasing day by day. So today, if you are able to live with a 25,000, 30 years down the line, that 25,000 will be equivalent to 1,90,000 thanks to the inflation. And if you're able to run your family with 1 lakh today, that number is 7,60,000, which is 7 times higher in 30 years of time. So if you plan to retire 30 years down the line, you will have to have a source of income wherein which it protects your monthly requirement post-retirement. Now, there are multiple schemes available in India to join for retirement, which is pension plans, public provident fund, mutual fund pension plans, national pension system, etc. So this can ensure regular income to you. This can ensure safe and secure investment. It can beat inflation. It is more tax efficient. So we're going to see that in a brief, that how different classes of retirement plan can help you in terms of creating a regular income post-retirement. So there are standard insurance retirement plans, which is having a debt category of investment. Risk is low, return will be around 6 to 7%, but lifelong, it can give you a regular income. National pension system has equity and balanced funds, which can probably give a fairly better return, but then it has a lock-in up to 60th of age, and it can give you regular income post-retirement. ULIPs are very, unit-linked, equity-linked saving schemes, which can again give a better return and regular income for you, post-retirement. Mutual fund, there is a function called SWP, Systematic Withdrawal Plan. Depending upon your risk appetite, funds can give you as high as 15% long-term return, and that can take care of your retirement income. So what is ideal according to us is a guaranteed income, a combination of guaranteed income and accelerated income plan with any of the equity linked scheme. So you need a regular standard income, plus you need an income to beat the inflation over a period of time. So a combination of any of this 4 or 5 things, out of the 4 or 5 things, any of the combination of 1 or 2 can give you sustainable regular income post your retirement. Now, generally, doctors ask us a common thing that we never going to retire. We're going to, we can treat someone. I think that's all possible when you're professionally fit, etc. While we wish that nobody will become millionaire, but then it is too ambitious. So people can get into exigencies, emergencies. So you need to definitely have a retirement corpus also. Keep it in mind so that we don't end up missing our lifestyle, etc. Post retirement. Coming to the last few slides of today's session is one is fraudulent investment schemes. All over the world the frauds have increased, especially in India. You have seen in the name of courier companies, in the name of police arrest, in the name of money multiplying schemes, in the name of trading, fast forward trading. There are people who offer you different type of all fraudulent schemes. Do not trust a single one. Nobody in the world will ever create a free income for you. Nobody will ever do a digital arrest to you. Nobody will ever do a ransom through bank account transfers. So all are fake. So please ensure wherever you are stuck, wherever you have a doubt, you can always pick up the phone on experts. And also one of that people can be at this thing is this office itself. So you can always pick up a phone on some of us, and we'll be able to guide you. So don't get into any schemes which offers you easy money. It's all for fraudulent thing. Coming to the tax efficiency. So please look at it wherever you can take tax exemption. Tax exemptions require little amount of patience and advisory. And it is legal way of managing your funds in a better way. For example, by taking a health insurance, your advantage is one, you will save tax. Second, you will take care of the health emergency. By taking a home loan, you would, if you are in the old scheme of taxation, you would get a tax exemption, and also you will be able to meet your home objective faster than what you think. So just because you have cash in hand, do not go for the best tax efficient way to manage your investment. So this we will share it with you directly, so that because it require you to sit with the chartered accountant and plan it based on these things. So we will share this slide with you, tax efficiency slide with you. Now, this is a typical dilemma which we all face in 20s. We think that too early to plan for a proper financial management. 30s, we are busy in setting up our home or getting married, having children, etc. So we think that we have enough time, so we'll do it later. 40s, their education, children's education, home building, etc. become priority. In 50s, we think that uh, the marriage and then a lot of other things will take over. By 60s, you think that it's too late. By the time you realize that you're going to retire and not having sufficiently created corpus for retirement or corpus for a better life, remaining life. So please do your financial planning today before it become too late. Just to sum up, the doctors, of the takeaway of today. So we, like I mentioned, doctors are well educated and well intelligent people, but due to the time lag or lack of time, you tend to trust someone completely, and that trust need not be the best, giving you the best return. So please go for best professional expertise when it comes to your money management. Adopt wealth creation strategies of new India, where people are moving from traditional way of investment like land and FD to 6 or 7 different strategies we discussed tonight. Accelerate wealth in the next 25 years. We have seen India is becoming a Viksit Bharat, a developed nation. So 7% growth if India is about to grow. We all can expect our personal income to grow much faster, much better, because we are intelligent people. Like I mentioned, loans can be a good leverage to give you tax advantage and also giving you a leveraged income at early stage. Life has got many uncertainties, So one should not ignore the risk which life is putting across, like health, life, and so on and so forth. Retirement is sure it's going to happen. Never it is too late. So before it is becoming too late, start a retirement corpus, because in 30 years down the line, you will have to shell out 7 times of your today's cost to have the same lifestyle, and take tax benefit to the fullest. So this is our summary, which we want to share it with you today. And this is about Trinity Finvest. We are a financial services firm based in Kochi, and which is a well certified, well registered entity. This disclaimer is important for us to speak to you that mutual fund investments are subject to market risk. Please read not only mutual fund, all investment related documents carefully before you take a decision to invest. There are different risks associated with the different investments. So please go through and ask, get clarity before you take a decision to go for. So follow us. The one thing which I want to say is that our Instagram and all can have a lot of information related to different financial needs or financial planning, what you need to follow. So please follow us. We will be able to help you with more, detailing. And our organization is created after this 25 years of banking experience with a vision to enhance financial well-being of individuals, families, and institutions. So our mission is to create a good for the customer, good for approach, good for us approach, and we believe in trust, transparency, and ethics. So anything which comes to you, personal recommendations or a discussion, we will try to give you, including everything, the cost, the risk, the regulator, and so on and so forth. Yeah, this makes us different from the rest. We are a one-stop financial shop. Under one umbrella, we have investment advice, investment products, we have loans, we have risk management solutions, we have trading platform, we have financial education, retirement planning, so that we can be called as a one-stop financial shop. We have a rich experience, like I mentioned to you, some of the best in class product tie-ups. So we have whatever partners we chosen are the best in class. And everything is available today on mobile, so there's no paperwork. We don't sell a product, we acquire relationship for lifelong, where we nurture, we maintain confidentiality, and like I mentioned, we ensure periodically review with your financial status, so that every quarter you know where you stand. This is the broadly what solutions we provide under the brand of Trinity. We have the best in class industrial tie-ups. So everything we've chosen the best of India's fund houses, financial powerhouses to support the services. And everything is available on mobile now. So where you are in today, we are able to connect with you through the digital platform. So even investments, redemption, everything is linked through mobile application, where we have partnered with Value Plus Technology, in IIT based, technology platform, which can virtually do everything. And even existing your investment also can be imported and tracked through this platform, wherever you have done it from. Any broking firm, any bank, that all can be monitored through this. So please do your financial health checkup. Our team is equipped to give you advisory on bank FDs, stocks, mutual fund, insurance plans, loans, retirement plans, and whatnot. So whenever you require a financial advice, please feel free to pick up the phone on any one of us. We'll be happy to help.